in the markets in order flow, you cannot actually see pending orders. You just see active aggressors or passive
You can
orders.
only see passive order, like the only limit orders you see, or pending orders, is limits, buy limits and sell limits, buy limits below the price, sell limits
Okay.
above the price.
So when people talk about spoofing and this idea of like there's
Yeah.
a pool of orders waiting above, so the
Yeah.
market is attracted towards that. That is going to be buy and sell limits, not the buy stop sell stops.
Correct. It's a bunch of buy limits or sell limits, but they're generally not put to attract liquidity. They're trying to put a wall of fake orders there, or ghost orders, that are going to be taken out of the market as soon as the market reaches it, because they're trying to feel something below. So what you usually do when you want to trade a spoofing is you're also looking for a so-called absorption. So in the sell limit, there's a bunch of orders, and then below, there's very few orders that are in the book. But here, there's not a lot of orders actually executed. No one is really buying into them. And if someone tries to buy, they disappear. So they are fake orders. This is spoof orders or layered orders. And then you would see downstairs, all these sell orders are trying to make the market believe that we're going down, and that there's someone big saying we're going down today, guys. And what's happening really in the lower part is in the buy limit side, they're putting a so-called iceberg order. And an iceberg order is they're not the opposite of a spoofing. So they're showing just maybe 10 contracts, but they have ready around 100 or 1,000 contracts. Every time they get executed, they put a little bit.
It's a domino effect.
So it's a domino effect, and they get filled by not showing that they have an order, but absorbing all the selling pressure that they are artificially creating with the spoof orders up. So you would have spoofers here that trades into a trap, which is an iceberg.
Okay. And is this a strategy?
Correct.
Are the big players utilizing spoofing and icebergs as a way of confusing? And if they are confusing, who?
So before Navinder Sarao allegedly caused the flash crash in 2010, spoofing was illegal, but was very widely used by institutional traders and HFT firms. That was a really great case study of how, as long as the big market makers are doing something, it's okay. No one's going to say anything. But if you're a poor Indian guy from Hounslow and you make $50 million out of it, then you're going to get problems. But anyway.
Such is life.
Such is life, yeah. And so the whole point of this is market manipulation. It's pure market manipulation. Spoofing is illegal. Iceberg orders are not. Actually, iceberg orders, if you want to hide your order because you don't want to show it to people, because you don't want to impact prices, then for the exchange and for the regulators is okay. There's also different kinds of icebergs.
So why would any institution ever not do icebergs? Like,
They mostly do icebergs.
Is there any advantage of saying, hey guys, I'm willing to buy so much right now?
Hell no.
You want to be kind of secretive.
Of course. Okay. Most of the orders that are executed, you don't see them in the book.
Makes sense.
That's also why the order book is, if you want to become a book scalper, the first thing you have to understand is what you see is not reality, okay? Because most of the stuff that's put in the book is fake. So you have to understand how is it fake and compare it with actual traded volume, and then you will understand how to use the book. That's how all because people say, but there's a lot of spoofing, everything is fake, so it's not usable. No, it's just you have to understand.
You have to clean the data.
You have to clean the data and understand what's being executed, because book is just buy limits and sell limits. It's not executed yet. It's just intentional liquidity, but it can be easily faked. So with iceberg, the cool thing is iceberg orders have two types. There's two types of iceberg order. The first one is a native iceberg. So the exchange is allowing you to have an iceberg, and they handle it. They handle the execution of the iceberg. And they have a specific order ID that with level 3 data, you can identify with 100% absolute certainty. So the so-called MBO data basically allows you to see iceberg orders with 100% certainty, because the exchange is putting this order for a big market participant and fractioning it into very small orders. So you can see, where is it? Is it moving? Is it staying in the same place? Is it filled? Is it finished? There's a bunch of information there. Then there is these are native icebergs, and then there's synthetic icebergs. So icebergs which are created by the broker or by the firm, and they kind of create it themselves with the advantage of they're not really seen because it's anonymous. So it doesn't have the same order ID. Every single part of the order is a different order. There's some other advantages, but it's mostly disadvantageous. But there's a lot of stuff. There's a lot of stuff in order flow that is really interesting. But we're talking mainly about scalping mechanics.
Okay, so there's another question that, so what I find is the most important part of the market is usually reversal points, and usually where that happens is, let's call it market structure, supply and demand zones.
Yeah.
Just for the sake of simplicity, let's focus on a supply zone.
Yeah.
When price is entering that supply zone, and we're talking about the idea of price came to the supply zone, hit the stop losses of people, which is actually just pending buy orders, buy stops. Once those were executed, now the sellers are out of the market. There was a gap left, and then the sellers came in to fill the gap, and then the market went lower. So when you look at that in price action, you will see, okay, price wicked above a supply zone and shot lower and made the lower low. Manipulation.
Yeah.
First of all, I want to see that manipulation, is that an accurate word? And second of all, when price shoots down, that makes complete sense to me. You're filling a gap and the sellers are taking over, and the buyers are out. There's an imbalance. There's more sellers than buyers. But that portion of moving the market up and actually doing the sweep, let's call it, who would do it and why would they do it? Because from a speculator, it makes no sense to buy in a supply zone just to grab that liquidity and then be out moments later. So is that the exchange maneuvering price, or who is doing it, and why is it happening? That portion up.
It's really hard to say.
Okay.
It's really hard to say. Even understanding the depth of market mechanics, you can't be explaining every single market movement that happens. But if you were to say, okay, we're getting into a supply zone and we're trying to understand if we're going to go down or not. So what happens is a high of the supply zone is being swept. I don't think that whoever is moving the market, if let's consider it as being one big entity, would go as far as pushing the price all the way up to the supply zone and then even up just to see if maybe there is some stops out there. It makes no sense, because the amount of money you would have to put in place to see if there is actual orders.
The risk reward of it, yes.
And you can't be sure there's orders there. So I wouldn't say they are going up with that intention, but maybe if price has rebalanced a phase of very, very harsh market direction, and now it's rebalancing towards fair value again, which is where price started, so the origin point of the impulse, then I would say if we're maybe staying, again, it depends on the time frame, but if we're staying sometime on the supply zone and then the last upthrust before going down, that could be, that you could see that as some sort of manipulation, but I wouldn't say is the main driver of the next movement. It's more because if you also see volume-wise, the least amount of volume is played in spikes. Most amount of volume is played in the distribution phase. So there's a lot of volume going on in consolidation. The upthrust, I would see it like as a little fart, to just, let's see, but whatever. Like it's not crucial for me for directional bias on the meaning aspect of it. But statistically, which is what people should be interested in mostly for their trading process, there can be a good statistical edge to a high being swept and following opposite direction.
That makes sense. So one of your strategies was just actually selling after the sweep to fill the book.
Correct. It's a very short-term trade.
And that in pips, let's say, I know it's futures, but it could be 10 pips, 15 pips max. It's a very small, average, quick move.
The average was, the minimum I would take was 7 ticks.
Okay.
To usually a maximum of 15, because it's rare that it will go way higher than that. If that happens, I'm putting like my house on it, whatever. Like it's like I'm gonna sell my house and put all of the money into that trade if it goes more, because I know the statistical edge. The more volume there is in a stop run, the higher the likelihood that it's going to rebalance it out. It's like up. If you're going up to this is crazy sauce. I'm not sure why I'm giving it away like this, but after 1.5 thousand contracts in a 1 minute candle, he's like the probabilities get increasingly higher, like 80%, that it's going to reverse and rebalance that.